Welcome to Chapter 11 video lecture, How to Determine the Tax Obligations. So in the last chapter, we did NPV and IRR, and we said that is the criteria, and most of you decided you should go into the business. Your NPV was positive, your IRR is higher than your weighted average cost of capital. So now we should learn about another thing, that when you do business, when you make money, you have an obligation to pay taxes. And this chapter is about that. It's a purely accounting chapter. 4 concepts: purpose and methods of taxation, tax avoidance versus tax evasion, a hot topic these days, types of businesses and what type should you register your business as, and then what's the tax liability under that registration. Let's start with purpose and methods of taxation. What are the different purposes of taxes? Why does government tax its people, right? Particularly tax seems to have emerged as a bad word. Oh, you're taxing me. But what are the purposes? First is generating revenues to cover the public services, right? And you know that the public services like education, utility, roads, security, and these things are not free, right? And the government needs money, so through taxes they generate money. But then there's another purpose, is transfer of wealth. So when they tax people, they tax some people, particularly the richer ones, more than the poorer ones. So really, they're all consuming the public services the same way, but the rich are paying more than the poor. So there's really a transfer of wealth happening through the tax system. The third purpose is to induce desirable investments by giving a tax break, like the Destiny Mall in Syracuse was given a lot of tax breaks, motivating people to come and start their businesses. There are 3 popular purposes of taxation. What are the different ways the government earns tax revenues, right? Income taxes, whether it's corporate income or personal income, property taxes, sales taxes, road taxes when we pay tolls, import taxes, export taxes. There's a lot of talk about it these days as well by our president. Registration fees when you have to register your car, estate taxes even when you die, and when your assets are going to somebody else, and there are tax implications. Payroll taxes, your employer is supposed to deduct taxes to Social Security as well as to pay the government ahead of time, and then later you file your taxes and do the reconciliation. Excise taxes on some special goods. Okay, let's stop and think on the purpose and methods of taxation. Which of the following is not a valid purpose for taxation? To provide public services, is that a valid purpose? To transfer wealth, is that a valid purpose? To build a border wall, all of the above are valid purposes. Take a minute. Okay, the correct answer is D, because we just studied provide public services, transfer wealth, then to induce investments. But to building a border wall is from taxpayers' money is a fair game, but it may not be the best game. It may not be the best use of tax revenues, but it is a valid purpose for taxation. Okay, second concept, tax avoidance versus tax evasion. Tax avoidance, you want to do; tax evasion, you do not want to do. Right? So what is tax avoidance? Tax avoidance makes careful interpretation of tax laws to avoid taxes. It's kind of tax planning, right? To minimize your tax obligations while being legal. Example, using accelerated depreciation for tax purposes, even though straight line may be used in financial statements. That's tax planning, because accelerated depreciation tends to reduce your income in the early years, therefore your taxes. Some tax avoidance strategies, however, while legal, may be unethical. It's not illegal, but you are intentionally doing something that you know is not right. Example, intentionally overestimating the allowance for bad debts expense, so you get to show a higher level of bad debt expense to bring your income down and taxes down. So you know the estimate you are making is too much, but you know it's allowed under the rules, would be a question. And even our president, I personally believe, is reluctant to release his tax statements out of fear that there may be things that are unethical and that can be politically costly for him. Firms often hire smart tax accountants to save on their tax expenses, so they avoid taxes. Now contrast that with tax evasion. This is a no-no. Tax evasion is evading taxes by hiding income from IRS. Particularly, people are tempted to hide income that IRS has difficulty detecting. Example, cash income. So babysitting income, tips, it's paid by cash, and there's no paper record, so you may be tempted to not report it. Or income from foreign investments, particularly in countries where there is no need to pay taxes, so there won't be any paper trail on those things. So you may be tempted. So, but you're really hiding income, and that's tax evasion. And such tax evasion is illegal and can bring a criminal conviction to an individual. Okay, so let's take a quiz on tax avoidance versus tax evasion. Which of the following is not tax evasion? Not reporting cash income, not reporting foreign investment income, using a higher allowance for doubtful accounts to lower income and taxes, falsified charitable contributions. Take a minute. The correct answer is C, because not reporting cash income is tax evasion. Not reporting foreign investment income is tax evasion. Falsified charitable contributions. So by this, you are lowering your taxable income. That's tax evasion too. But this one is tax avoidance. You're using, sometimes it could be unethical, but that's not tax evasion. It's tax planning. Okay, so third purpose, types of businesses, because the taxes you have to pay depends on the way your business is registered. So the basic ones are sole proprietorship and partnership. Sole proprietorship refers to a single owner and is a simple form of business. And it does not require any paperwork. Partnership, also a simple form of business, but has multiple owners. As such, it often requires a partnership agreement stating the roles and the percentage of profits of the different owners. In Lebara, of course, if you recall, the owner was saying they didn't even have a partnership agreement. They had kind of a gentleman's agreement that they share the salaries and profits equally for some time. But typically, it's good to have a partnership agreement, and most entrepreneurial ventures begin as a sole proprietorship or partnership. Okay, both sole proprietorship and partnership are seen as an extension of the owner. So it's kind of an extension of, it's like your hand. Right? As such, the business income is added to other income of the owner. So you may have salary income, you may have other investment income, then you have business income. Everything is pooled together. These are different extensions of yourself, and all of them pooled together, and you pay taxes on the total income. The downside to sole proprietorship and partnership is that they expose the personal assets of the owners to business risk. Because if something goes wrong in your business, is not only the assets of the business, even your personal assets like your home, your vehicle, your life insurance policies, creditors can come after them. If business goes under, the creditors can lay claim to owners' personal assets. So what's the solution to this is corporations. Business owners can separate themselves from the business by incorporating the business. You would have heard the term corporations. Such incorporation also makes it easier for the entrepreneur to raise funds, because the moment you incorporate a business, the corporation becomes a separate legal entity from the owners. So when you want to raise capital, and those outside parties feel more comfortable if their personal assets are protected, and if that is, by that they mean if your business is a corporation, because it's separate from the owners. The downside of corporations is they have to maintain financial statements and they have to be audited because it's a separate legal entity. Also, in the case of, in this case, both the corporation and the owners pay taxes separately. Corporation has to pay taxes, owners have to pay taxes. So the dividends paid by the corporation to the owners, they paid with after-tax money, but however, that dividends also get taxed from the owner. It's considered an income. This is called double taxation of dividends. So what's the general recommendation for a startup, particularly you guys? Register the business as an LLC, known as the Limited Liability Company. Limited Liability Company, while treating the owner and the business as one entity, it's still an extension, only you pay taxes. It limits the liability of the entrepreneur, that, so, which is nice. It involves minimal paperwork. It avoids the problem of the double taxation of the dividends. Okay. Why is an LLC the preferred option? It protects the personal assets of the owners. It avoids the double taxation of dividends. It has less paperwork. All of the above. Take a minute. Pause the video if you have to. The correct answer is all of the above, because all of this is true, and makes LLC a preferred option. Okay, let's come to tax liability. What are the determinants of the tax liabilities of an LLC? So now you need to pay taxes as an LLC. What determines? Two things. First is taxable income, your incremental taxable income, and the marginal tax rate. Taxable income is your operational cash flow minus some tax deductible expenses. So the amount of cash that the business gives you, you don't pay taxes on that. IRS allows that. They got to allow some valid expenses to be deducted. What are some examples? Initial expense for, like, the legal expense and initial promotion, and IRS realizes that you got to allow that to be deducted. Depreciation expense, your assets are losing value. Interest expense, you borrowed money to finance your startup costs, and then you got to pay interest on it. Bad debt expense, if you're doing credit sales, some of them will go bad. Charitable contributions, if you make, because government wants to encourage charity. So these are valid tax deductible expenses. So from operational cash flow, you go to taxable income by taking this, and then times that the marginal tax rate. Marginal tax rate is the tax bracket the entrepreneur is at, which is based on their current taxable income. So think of it like three tax brackets: low income, middle income, high income. Low income, your tax rate is 0 or pretty low. Middle income, let's say you're taxed at 20%, and high income at 30%. So if you are in the middle income tax bracket and your business is bringing you more income, so every additional income is going to be taxed at that marginal tax rate of 20%, versus the same business for a high income person will be taxed at 30%. This is the applicable tax rate for the incremental taxable income. So if you look at our sample business, so here is your cash flow inflow from operations. You don't pay taxes on this, even though so much money the business is giving you. IRS says there are some valid expenses, your startup expense. You say, okay, and the first year itself you deduct that, because the rest of the startup costs, or at least most of it, were a long-term assets, so they were capitalized, and then you did depreciation expense over the years because they were used for 5 years. Then interest expense. We borrowed money, then you pay interest. The reason it's only appearing for 3 years is we will see in class that you may want to pay some of them back. Other tax deductible expenses, bad debt expense, charitable contributions. So then you get your taxable income. So you see it's a lot lower than your cash inflow from operations. And on that, here is your marginal tax rate. You are in that, you're assuming once you graduate, start making an income, you'll be in the middle income tax bracket, and you can all assume 20%. So 20% of this, you get these numbers. But note, first year is negative. That's typical because of your startup expense. Your taxable income can be negative. So what does that mean? 20% of that is a negative number. So this is like, because the business is an extension of yourself, so if the business is showing a loss, it offsets other income you may have. So really, you're going to save taxes because your business is showing a loss. So many people kind of like to show a loss in their business, even though business may be giving them positive cash flows, because that tend to bring down their tax liabilities. For example, if you use your home for business also, part of your rent can be charged as rent expense. And so you tend to show a loss when you go on a trip. A part of your gas cost and depreciation can be charged to your business. And all right, so when then should a business owner incorporate? So I'm recommending you to be an LLC. When might you consider to incorporate? When the business owner has to raise funds in exchange for ownership. Like we said already, if you want to go to angel investors and ask them to become owners, they would like to see you be a corporation. Even though limited liability company limits their liability, they don't know you that much and they'll be hesitant. But if you're a corporation, they know only the money that they give you is at risk, not their personal assets. Sometimes an entrepreneur wants to incorporate to take advantage of tax brackets. For example, for not-for-profit organizations, if they incorporate and get the 501c3 status, they get a tax-free status. Their income is not taxed, and any contributions people make to them is tax deductible for them. Okay, so if you incorporate, then your corporation is separate and there's going to be a corporate income tax. Now that is based on net income before taxes. It's kind of the taxable income for individuals, then times your corporate tax rate. Corporate tax rate is one flat rate, and it's not like the low income, middle income, high income. And the NIBT is the net income before taxes. This also includes the owner's salary expense and resource rental fee, because if you putting your time into it, they have to pay you salary, and that is a valid tax deductible expense. Okay, stop and think. If the business is a limited liability company, the operational cash flow is 5K, tax deductible expenses are 15K, and the marginal tax rate is 20%, which is true. The business owner does not have to pay taxes, pays taxes of 4,000, pays taxes of 2,000, saves taxes of 2,000. Pause the video and see which is correct. The correct answer is D, because 5K minus the tax deductible expense is 15K, then your taxable income becomes negative 10K. And then times 20% is negative 2,000, because that negative 10K will get aggregated with your other income, lowering your overall taxable income, therefore lowering your tax liability overall by 2,000. Okay.